Good morning.
Goeiemôre.
And how is everybody on this lovely Thursday morning? So this morning is a topic is a bit, I would say, of a shaker, so grim one. But let's not be too grim this morning. So please keep on smiling and ask your questions as you go along. We will be here to answer most of those questions. So this morning's is all about the financial reality check, what every New Zealander should know in 2026. So point one. The big question is, what if you lost your income tomorrow? How long would your household survive? That's a big question. It's not your job, it's not your title, it's not your house, it's your income. Would you last for 3 months, 6 months, or would the pressure start immediately? Would the pressure start within 30 days? So, uncomfortable truth here is many New Zealand households are running very, very tight budgets, or margins, if you want to call it that. Groceries are up, insurance premiums are up. We've seen some of the health insurance premiums go up by 30, 40, 50%.
It's actually
It's
ridiculous.
it's a bit scary.
Oh,
It's a bit scary, eh? Interest rates have stretched mortgage repayments. Interest rates are down now, but the banks is already putting them up again.
So are they expecting something?
The bank, I don't always believe any reserve bank of any country because they got to play along with the politics in the country. But the banks are the real barometer of any country. If the banks start putting up the interest rates, it's because your CPI, consumer price index, is too high.
Okay.
And banks are much more touchy on that subject. So I think two of the big banks has already started upping their long-term rates, which means they foresee that in the future there's going to be a rate hike, not a rate lowering.
Okay.
And I doubt if the rates will go lower than what we are now.
Okay.
All right. So at the same time, we're carrying some of the highest household debts in the world. So most families have a mortgage that requires 2 incomes to survive, which makes both people in the house has got to work at least. Sometimes when I ask people what will protect them financially, the answer is almost always, ACC will cover me. I've got KiwiSaver, work as some cover. Or the big one is, oh, she'll be all right, mate. Yeah, that one. So I know. In New Zealand, people are more likely to insure their youth than they are to insure their life.
Yeah.
Sadly enough. So,
But with people coming from South Africa, you don't have that problem. They know where
they know, but South Africans only form a small part of the reality of the larger amount of people in New Zealand.
No,
so
Kiwis
aren't good with insurance. So sadly enough, but one day perhaps. So I want to see if Vanita said good morning on the other side. Good morning, Vanita. And then I want to break down what Kiwis thinks protect them and what it actually does. So the income myth in New Zealand is, let's start with something simple. Your income is your biggest financial asset because you are working for that. You're taking time and you're exchanging that for money. It's not your house, it's not your car, it's not your KiwiSaver, it's your income that's your biggest financial asset. So if you're earning 100,000 per year and you work for more than 25 years, that's 2.5 million of future earning power. So today, earning 100,000 for the next 25 years, that will be $2.5 million of money that I can possibly earn. Yes, you can get a better job and get high pay and so forth.
Yeah.
So, but the strange part is we insure our $40,000 car, we insure our house, we insure our phone, but we don't insure that multi-million-dollar asset called yourself. So that's a big problem. People assume ACC will cover everything. Yes, ACC does cover accidents. That's very, very important. ACC covers it for everybody. So either from a visitor or to a permanent citizen, resident, whatever you are, they cover you all. But it does not cover illnesses. So if you have got something like cancer, heart attack, stroke, one of these type of things, you're not covered at all. I've got your autoimmune diseases also not covered. It's also a big thing. Cancer is a big claim in New Zealand. So long-term disability, the joke is, it's more likely to come from an illness than from an accident. And I know a lot of people use ACC, and I would say they use it too much.
Yeah.
You bump your knee and you're off for 3 weeks or for a month or something like that.
And the thing is, it's not only the people that it happens to, it's also the service providers. They kind of, they misuse the system, I would say.
Yeah. And it's fine if you got a boss.
Mhm.
Okay, you got to break this basically in two parts. One where somebody's got a boss, and the other one where they're working for themselves.
Yeah.
Now, it's fine if you've got a boss. The boss will still go on with the business. You'll get 10 days of sick leave and so forth, fully paid and so forth. But if you're self-employed, the exposure is even greater. No sick leave, no employer subsidy. The revenue stops. Tough. Let's take a plumber. A plumber works with these two things. He goes out, fixes a lot of other stuff, and works with people's shit. That's a plumber. A dentist the same. A dentist works with these two things, and he goes into people's mouths and does certain things. If you can't use these two things for a period of time, the revenue stops. Except if he's the owner of the business and he's got 10 other plumbers working for him and they can go on. But mostly in New Zealand, you've got one-man bands, if I want to call it that. Nothing wrong with that. That's probably the best thing you can ever do. And I know a lot of people who had bigger teams are now going back to being a one-man band.
Yeah.
So it's just less stress on them.
Yeah.
But if anything happens to that person, the revenue stops that moment.
Yeah.
It's not going to come in the future. Nobody's going to say, oh, you didn't fix my toilet, but here's $100. Or, oh, sorry, you couldn't do my teeth. There's $1,000. You know, that's not a charity. So at the end of the day. So, yeah. So here's I wrote this down. I've got a 40-year-old earning $110,000 per year. Mortgage, 2 kids, busy life. Now, imagine they develop a serious illness and can't work for 5 years. That's $550,000 of gross income gone. Not reduced, just gone. They didn't lose their job. It's something out of their control. It wasn't because they were not good enough for the job. It was just because they became sick. Meanwhile, Mr. Bank still wants the money for the mortgage. The food needs to still be bought. Kids want to eat. Wife wants to eat. Families, bad people, man. School fees continue. Life keeps on moving. And this is the real life for a lot of people. So the risk isn't dying. The risk is living without an income. Other thing that we talk a lot about is KiwiSaver. It can also be a safety blanket up to a point. All right. One of the rules of KiwiSaver is that you can get KiwiSaver when you are in hardship. Now, hardship, it takes a while to prove that point one. So today, you are in an accident or an illness and you can't work further. Let's say an illness where ACC doesn't kick in at all, and you can't work for the period of time, you've got no insurance, none at all. Then hardship comes in the form of KiwiSaver payout, but they would love to see you have tried at WINS. They'd love to see you've tried everywhere else. And I think they only do something like 6 or 7 weeks. Sorry, I'm talking on the correction here. Under 6 or 7 weeks of real expenses of, I have to show my bills to them and say that will be the price for the next 6 or 7 weeks. But what if I can't work further? What if I'm off for 5 years? What then? 2 years? So, and just remember something. If your KiwiSaver is small, and that's one problem with a lot of South Africans. The KiwiSavers are small because they've only came to New Zealand now. It takes them a while to build this up.
Yeah.
KiwiSaver aren't going to give you more money than you've got in there.
Yeah.
So if you've got $20,000 in there, you'll probably be able to get about $18,000 of that for hardship. But that can take about 6-7 weeks just to prove all of that. So for this period of time, there's no income.
And the thing is, if you use that KiwiSaver money when you really need it in the long run,
retirement is a
gone.
problem. Yeah. So, and the problem is with a lot of people, the balances are much lower. And it's not because the KiwiSaver didn't grow. KiwiSaver, if you do it right, really grows at about between 8 and 12%. It's because the time that they are in the KiwiSavers aren't that long yet.
Yeah.
Especially people working for themselves. All right. Of super individuals, I want to call them that, sometimes is super stupid. Okay. So if I offended you this morning by saying you're super stupid and you are part of this, call me. The reason why I say they're super stupid, they pay everybody else. All right. They will pay the secretary. They will pay the 3 guys working for them. They'll pay all the bills. They pay themselves last. And the last thing that they ever pay is KiwiSaver. So they would say, okay, the minimum that you can pay per month or per week just to get the government contribution is $20, I will only do that. It's about $1,000 per year. In about 20 years, it's about $20,000 they've paid in there.
What are you going to do with that?
It has grown a bit. Let's say it's gone up to 30,000. Let's say it's grown double in 20 years. Let's make it double. It's grown to $40,000 in 20 years. So at age 65, they've got $20,000 or $40,000.
Yeah.
Wow, you can't even buy a second-hand Nissan, man. So you probably can buy a second-hand Nissan, but it really limits you to the day that you retire, and that's one thing that a lot of people do. They are either in the wrong KiwiSaver fund, point one, or they don't save enough.
Yeah.
Now, when I say save enough, and our finances have been tested this year, it's been a very weird year. You have to have at least 3 months of operating expenses somewhere. If you can't go on, and I'm not talking you are ill or you've got a disease. I'm just talking about something happened. The economy is the way that it has been this year.
Business is slow.
Business is slow. People take long to pay because there's a lot of people that want the work to be done. But the problem is that they take forever to pay. I know some of the guys tell me they've moved up from 30 days payment now to 90 days payment.
Oh, wow.
That's 3 months. That's 3 months without any pay, but you have done the work. You have bought everything else. You supplied all the goods. Yes, I know it's still your goods, but it just takes much longer now to get the money in. So you have to have a backup, an amount of money that you save for a period of time just to survive this type of thing. So the problem is with something like that, you won't be able to tap into your KiwiSaver. So we advise people to have a second, either in the bank or a separate type of investment account for that. KiwiSaver is still important. Don't
You
get
can't
me wrong.
save in KiwiSaver. You can save
For your retirement, but you can't
save
save for day-to-day stuff. And it's important to save for day-to-day stuff because suddenly a lot of things happen. For myself, even once a year, I get all the insurances I need to pay. I've got to take out personal indemnity on myself. That's nearly $8,000. That's one insurance. Then I've got to do the house insurance, car insurance. And weird enough, everything is very much
the same
the same. I would say the same 2-3 months. So that's a lot of money just coming out at the same time. Vanita saying what I don't like about KiwiSaver is the monthly admin fee for management of the fund. Vanita, I hear where you come from, but you can do it on 2 different ways. You can either have a monthly admin fee, or you can have one that's going to ask you much less. There is going to be an admin fee because somebody has got to admin it or administrate it. Sorry for that. Administrate it. I love the fact that I have to pay an admin fee. Be quite frank on that, because then I know I can choose my manager. I choose the fund, and the fund is the manager. The manager runs the fund for me. That manager is bound by certain rules and regulations. Everybody pays the admin fee. It could be 1%, 1.5%. I know it sometimes sounds a lot, 1 to 1.5% per year. But now you've got an active managed fund. So this manager sits there, and his work is to make money. And his work as well is to preserve money. Some people have seen that the one company that I use a lot, Milford, has gone into a bit of I would say, a 2-month slump now. The reason why they went into that is because they preserve money. They're moving money out of the US into the EU type of investments, trying to get a wider diversity over the EU. But in the meantime, they're trying to preserve the money. If anything bad goes wrong, that you not have all your eggs in one basket. So diversification is so important. And even for yourself to try diversify your own portfolio on the stock market, you just don't, you need $50 million basically.
And you'll have to sit there the whole day, and that's all
you have to sit there, or you have got to have a type of buy and forget type of attitude, and not a lot of people has got that. That's the one. Good morning to Heidi as well. It says good morning on Facebook. I don't know which page down there. So the other problem with KiwiSaver is people go in either too conservative when they're young, and sometimes they go in too aggressive when they're old, or they don't ever review this, or they are solid in the wrong company. You do get companies that's out there that just ticks along, and everybody feels it's good because they're getting 2 or 3%. And I know it sounds boring, but at the end of the day, at age 65, and you've been in this fund for 40 years, you're not going to be very happy once you see the returns really over the
Yeah.
period of time.
The thing is, when you're young, and I know, I mean, we talk from experience, when you're young, you think retirement is very far.
Oh, yeah.
So you still have time.
I mean, I still think retirement is very far, and it's not. It's 12
It's
years
not.
from
If
now.
sometimes I sit down and I think to myself, we only have like 15 years to actually create something because there's no more time after retirement.
And I want to say 95% of people is in that mindset.
Yeah.
Probably not. We're not even going to go on retirement, or it's still a long way off. And it keeps on being a long way off because you put it a long way off.
And the thing is, when you immigrate, especially at an older age, like we've immigrated when I was 45. You already starting
at the back of the queue.
At the back of the queue,
That's unfortunate.
It's already 25 years.
And it's not your fault. It's not a prime minister's fault.
And most of the time, everything that you saved up where you came from, you used to immigrate and you used to survive on while you're finding your feet. So you're actually starting from scratch. So you have to
You have to fight and claw your way to the top.
It's hard, but I mean, what happens when you retire one day and you have no money? What are you going to do?
And the other thing is, a lot of people say to me this: I don't know where my KiwiSaver is. My employer invested it for me. The employer is the owner of a plumber company. He's never had the faintest idea. He just chose a default fund. Oops, tick the box. There he goes. Your money's in there. Everybody's happy. And you think you're happy. You haven't got the faintest idea. You got to keep your eye on the ball. So I was going to give you an idea. If you take $500 per month for the next 25 years, if you get a 7% average return, you'll have over $400,000 in that fund. If you get a 3% return, it's only $230,000 that'll be in there. So nearly double the amount of money by just a small percentage change. Not any cent more out of your pocket. It's the same amount out of your pocket. If you take $500 either in a lower growing fund or in a higher growing fund over this period of time, and the higher growing fund is doing so much more, way more.
I think what happens, because I sometimes also I kind of think this way, is you're scared of losing the money that you invested. So you'd rather, if something happens, lose only 3% than losing 7%.
It is. That's why, point one, you got to work with somebody that's a trusted advisor, point one. The joke is these days, there's a lot of firms popping up. And yes, in their first day, in the first year, most of the investment firms do good. I'm going to say this again. In the first year, or let's say the first 3 years, most investment firms are doing good. Why? Because they haven't got the backlog of all the years of growth or negative growth that hampers their figures. But thereafter, after 3 years, once the stats are piling up now, then suddenly it shines through and you can see, oh, well, these guys did make 10% in the first year, 10% in the third year, but now in year fourth, they're now dropping down because they haven't got the backbone that all the bigger companies have got. That's why I say use a trusted company, use a manager that you pay to manage your stuff. Don't just leave it ticking along. That's the one big problem. Somebody just saying, Antonio Kulpan saying, let's be honest, not many people are going to be able to afford to retire. I fully agree with you. The way that this country is going on, not a lot of people are going to be able to afford to retire. But if you at least got a little bit more money and still be able to do less work, let's say work from 5 days to 3 days. I spoke to somebody yesterday. Guys, actively working with his hands. He's about 50 years old. And he says to me, it's getting to him now. I fully understand. Carrying around machines and working with his hands at age 50 is hard work. It's very, very hard work. What he wants to do in the long run is try and go down from 5 days to 3 days. And if he's got the backup, which we are busy implementing for him, if he's got that backup, within 5 or 10 years, he can move over to only working 3 days and supplement his income then from the KiwiSaver growth or the investment growth.
And the thing is, what one of the positives of New Zealand is they won't chase you away when
Yeah.
you reach retirement age. That you can keep on working until you can't do it anymore.
And
So you'll be able to, and they're very lenient
Oh, yeah.
with
and the
working
nice thing
only
is,
a few days a week.
jobs that people look down on while they were in South Africa, you can do here.
Yeah.
And nobody would think it's strange of you to drive the school bus.
No, and you
Or,
still
to-
earn
earn
good
decent
money.
dong. That's
Yeah.
a big thing. You
Yeah.
can still earn about $25 to $30 an hour. So yeah, it's just one of those things. You got to be honest with yourself and have a holistic look at your finances. Point one, have a holistic look at your retirement as well,
Yeah.
and see, am I going to be able to retire the way that I'm going forward?
Yeah.
And if the answer is no, and you don't do anything, then you're blind. Because you have the problem. And if you don't know how to do anything, give somebody like me
Yeah.
a call and say, this is what I have. This is
Yeah.
where I can't see myself retiring in 20 years' time because I do not have enough money.
Yeah.
How do we change it? And it's better to change it 20 years before retirement than a year before retirement.
Yeah.
Because then I'm going to tell you, a year before
Yeah.
retirement, I'm going to tell you, work on.
And which is say, let's look at it this way: the cut-off date for immigrating to New Zealand is 55.
Oh, that's the last time you can get
Yeah.
residence. Yeah.
So if you get here, if you immigrate when you're 55,
You're probably only going to get government super at about 68, 69 years old. That's
Yeah.
14 years down the line.
yeah. So what can you really actually save in 14 years' time?
As much as possible.
Mm.
As much as possible.
I'm just taking worst case scenario. The guys
Yeah.
that really come in last minute.
Last minute.
Yeah.
You've got to save as much as possible. And really, I know people say to me, yeah, but we got to live as well. But go and look at your expenses. Go and look at your expenses. Go and take your expenses, run through them, see what you're doing wrong, see where you are actually bleeding money. Sometimes you're bleeding money on ways that you didn't even think. That Netflix that you took out, and I know it's small amount of money. It's $15 a month. What's Netflix? $15 a month. I'm not saying cancel your Netflix, but you could have Netflix and never use it.
Oh.
I had one of these things that was just ticking along, was something like $15 or $20, or another subscription, I think Neon or something like that. Eventually I thought, what was going through it didn't make me poor.
No.
Let's be quite
There was
honest.
probably at one stage something that you wanted to watch on Neon.
And
You got
I-
the subscription
and
you
forgot
watched
to
it and it
cancel
was
it.
gone.
But the problem was I had about 5 or 6 of these things.
Mhm.
And
It
I
adds up.
couldn't believe, and eventually I sat down with all my staff and I said, guys, who's using this? Who's using this? And it came to we were using 5 or 6 different ones that we're not using at all.
Mhm.
Then we had 1 or 2 that we could change to something cheaper and better. So this is small things. I mean, this is really small things. I'm not saying give up the morning coffee. It's a good thing to not do the paid morning coffee because it's expensive these days. It's about $7. And if you work it out over a period of time, normal people would say you could have bought a Ferrari, but I've never seen people who not start drinking coffee driving Ferraris. So. But there's very, very expensive habits that people do. Me, you, everybody else, we do on a daily basis, and we don't even realize this is bleeding us.
Yeah.
This is bleeding us. And I'm not saying don't go do anything. I'm not saying now for the rest of your life just go home and sit and wait to
No,
die. That's
you
not
have
what I
to
want.
treat yourself also
You
once in a while.
have to treat yourself, but treat it in a way that it's not going to impact yourself.
Yeah.
Cut up your credit cards. Sorry, I'm veering off a bit. Yeah. But we will have to continue. This is a part 2. So guys, get rid of the credit cards. Get rid of Afterpay. I sometimes see clients' bank statements and it's Afterpay about 50 pages for 1 month. And all these things are eating your future money. Because you take out a credit card. I think I've got a credit card. I think if I take money on that, it's something like 19% I got to repay.
Yeah.
That's 19% less of my future.
Yeah.
It's a heck of a lot of money. That's why I don't use my credit
Yeah.
card at all.
And I think your limit on your credit card is like $500.
Yeah.
You can't even go higher than that. So,
I actually got the credit card to buy a car through, but the bank took so long to give me the credit card. By the time they gave me the credit card, I bought the car cash. So yeah.
oh, look at that. Benita said she changed back to Spark. It's a service provider for
That's for
phones.
cell phones. So,
Of course, they offer Netflix.
yeah.
So that's
If
that's a way you can.
If that's a way you can
save.
save. Now, the other problem is, Vanita, I probably assume, and I'm going to make this assumption because I know you, that the money you save there, you're probably buying a coffee for hubby as well. So
Not put it in your savings account.
savings, guys, is a habit, like anything else. If you smoke, that's a habit. If you drive too fast, it's also a habit. It's a bad habit, but it's still a habit.
Yeah.
Savings is a habit. Savings right is my type of habit. I like to help people save money. I like to help people see where there's weaknesses in their portfolio. And sometimes people tell me, "Oh, we with this company and we're doing so good." Until I look at the company they are in, point one. Point two, they haven't been told the real truth by their advisors, because the fund they tell me they are in, it's going really good. They're not even in that fund. And I find it very, very often. Very, very often. People are, it is as if when they are working, they are blind to finances around them. I don't know why. And I've got a financial brain, probably looking at life a bit different, but some people just go to work, come back, give the wife the paycheck, and everybody's happy. Age 65, give yourself, I only got this. You could have seen this amount 20 years ago. You could have run this amount through an Excel spreadsheet if you're not savvy on a computer or a calculator. I use Excel spreadsheets for these type of things easily. There's a lot of other programs I also use for this. But then you can't make a mistake. And even at worst case scenario, most people, if they look at the KiwiSaver today, are going to tell me, "Geez, I will never be able to retire." Because the government subsidy or the government pension, let's call it a subsidy, is small. It's really, really small. You have to be totally cashed up. You have to have no debt. And I'm going to have mortgages even after and most South Africans that I do know is going to have a mortgage even after retirement.
Yes.
And the problem is that's still got to be serviced. You can't go to ANZ and say, "Some guys, I'm not going to pay you further. I'm retired." I can't show what ANZ is going to show you, but yeah. Vanita says she only buys 1 or 2 coffees a week. She don't spend. Your kids make me poor.
I know, children.
That's the other thing. Vanita, get rid of them. Get rid of them. Get rid of them. Give them to hubby. Yeah, and unfortunately, in the day and era that we work with cards. A card, and
it's so easy to
and
swipe.
I'm not old school. Please get me right. Cash were easy. You had cash in your hand. You had $100 in your hand, and if you had to pay 20 for that, you had 80 left. You could see the amount going less in your hand. Now suddenly, swipe. Tonight you sit there. Jeez, did you see that $2 thing I bought from the warehouse cost me $254.39? Yeah, it's easy.
It's true.
It's easy to spend money, and the media, Facebook, wherever you are, is making it so much easier for you because you need all the stuff they
That's
show you.
the thing with this online buying. That's the thing with this online buying.
Renier Klaassen just saying it's difficult to save before having a residency. I know residency is very expensive, but it's something you got to do cash. And don't get me wrong, yes, some people do need a loan for that. You need to get residency. But if you can do it cash, you're in so much better position right now.
But there's a lot of people in that situation where they save, but it's only for residents. You don't have enough to save for residents and a little bit more. The only thing you can save for is residents. But yeah, it is the most important thing.
Okay, a quick last thing for me. I want to tell you what one of my clients did. It's only one of my clients did this. He came over, he got the job. Wife came over, she got the job. They took her full salary because at that stage when she arrived here, she was here 2 or 3 months before she got the job. They learned to live from one salary. Okay. Now they are about 45 years old. Okay. That was about 5 years ago. They took her full salary every month and saved it. The full salary. They cut it to the bone. They used his salary only. They took her full salary and put that aside every month. And they bought themselves very near to a cash house at the end of the day. The mortgage is very small, but they put all of her money just like that into that.
Yeah.
So
the thing is, if you put your mind, do something,
you can do it.
Can do it. And if you've already survived on one salary, even if you like you say, you have to kind of live
And you have to make compromises in life. You have to make.
Yeah.
If you want to become fit and strong, you got to go to the gym.
Mhm.
I mean, that's why I don't go to gym. I don't
You
want to
don't
become,
want
just,
to
I don't become
no, I
strong.
know, yes.
If you want to retire with money in your pocket, I'm not going to say rich. If you want to retire with money in your pocket, you got to make compromises before retirement. And that is by putting money away. It's with
Yeah.
anything else. If you want to become a doctor, you just can't wake up one morning and say, oh, I'm going to become a doctor.
Yeah.
You can do that, but you got to study the period.
Yeah.
You got to make the compromise. You got to change your life and go and study
And
until you are a
I
doctor.
think that's where we, with KiwiSaver, I'm talking specifically
Mm.
KiwiSaver. When you bring your children over when they're still in school, they don't realize then how fortunate they are, but they can start KiwiSaver immediately.
Yeah.
When you've got residents, your kids can get KiwiSaver, whether they are 2 years old or 20 years old, they can get KiwiSaver.
The only trick is they got to have an IRD number.
Yeah. So, and they can start saving. If you can start saving in your KiwiSaver when you are still in school, can you imagine by the age of 25, you'll be able to have a deposit to buy your first house? Where in the world did we have that?
And if you are going to teach your kids to be poor, they are going to be poor. Teach your kids to work for money. I don't care what parents say. Teach your kids to work for money. Show them the value of money.
Mm.
If you work, you'll get money. And whatever they earn, make them put 50% of that money into the KiwiSaver.
Because they don't need
They
the
don't
money.
need the money.
Yeah.
No. Sometimes, yes, they do need the money because they want to pay or buy a
Car or whatever.
car, or some of them want to buy a PlayStation, or they want to go overseas on a rugby tour or something like that. I fully understand that. But still, 50% of that money has to go to KiwiSaver.
They don't need to pay for daily expenses.
No,
That's what
no.
we're
If
parents
your
come in.
kid can be at age 25 and they can have a good deposit for a house, you set them up for life. I promise you.
Yeah.
It's an eye opener. It's an eye opener.
No, that's true.
I never had it. She never had it. No, none of the South Africans had it.
Yeah.
But you can be the difference. All right, guys, enough of that. Goodbye. It's Thursday. The weekend's not going to look bad at all for those guys fishing's out there. So
It rained last night. Did you
it
know?
rained last night. It's good. It was very, very dry. So I actually thought, wow, what a good thing that it rained. So it was very dry. All right, that's us for today. See you next week, same time, same place.
Bye.